Prices of goods and services are determined by a complex interplay of various factors. The fundamental forces of supply and demand play a crucial role. When demand exceeds supply, prices tend to rise, and vice versa. Production costs also influence prices, as higher costs for labor, raw materials, and other inputs can lead to increased prices for consumers. Additionally, competition affects prices. More competition usually drives prices down, while monopolies can drive prices up. Government policies, including taxes, subsidies, and regulations, can also significantly impact prices. Inflation is a natural economic phenomenon, representing the rate at which the general level of prices for goods and services rises, thereby eroding purchasing power. It is usually measured by indices like the Consumer Price Index, CPI, or the Producer Price Index, PPI. A moderate level of inflation is common and considered normal in a growing economy. However, inflation can be caused by various factors. Demand pull inflation occurs when the demand for goods and services exceeds supply, while cost push inflation happens when the costs of production rise, leading to higher prices. Built-in inflation results from the expectation of future inflation, leading to a wage price spiral. Monetary inflation occurs when there is too much money in circulation relative to the economy's capacity to produce goods and services. Economic growth and innovation make static prices impractical. As economies grow, production methods and technologies improve, and consumer preferences change, static prices would hinder these natural evolutions. Dynamic prices help allocate resources efficiently, signaling producers to increase supply when certain goods are in high demand. Additionally, global influences such as natural disasters, political instability, and changes in trade policies affect prices, and static prices would not reflect these realities, leading to imbalances and shortages. Labor market dynamics also necessitate price changes, as wages and labor costs fluctuate. Static prices would make it challenging to adjust wages in response to changes in labor market conditions, potentially leading to unemployment or labor shortages. Inflation has several effects on purchasing power. It erodes savings, as the value of money decreases over time. For instance, with an annual inflation rate of 3%, $100 today will be worth only $97 next year in terms of purchasing power. Inflation also redistributes income, benefiting borrowers who repay debts with cheaper dollars and hurting savers whose money loses value. Fixed income earners and retirees are particularly vulnerable as their income doesn't increase with inflation. Additionally, high or unpredictable inflation creates uncertainty, making it difficult for businesses and consumers to plan for the future, which can reduce investment and economic growth. Governments and central banks have several tools to combat inflation. Central banks, such as the Federal Reserve in the U.S., control inflation by adjusting interest rates and using other monetary tools. Governments can also use fiscal policies, including taxation and spending policies, to influence economic activity and control inflation. Investors can protect their portfolios through various means, such as investing in Treasury inflation-protected securities, TIPS, which are U.S. government bonds indexed to inflation, and real assets like real estate and commodities that can hedge against inflation. Diversifying an investment portfolio by including a mix of stocks, bonds, real estate, and other assets can help balance the impact of inflation. For businesses, controlling costs can help mitigate the impact of inflation. Improving efficiency by streamlining operations and negotiating better terms with suppliers to secure favorable prices are practical strategies. Individuals can seek to adjust their income to keep pace with inflation by negotiating for cost of living adjustments or merit-based raises and investing in skills to increase their earning potential. Historical perspectives on inflation provide valuable insights. Extreme cases of inflation, known as hyperinflation, have occurred in various countries, such as Weimar Germany in the 1920s and Zimbabwe in the 2000s, leading to astronomical price increases, economic instability, and severe social and economic hardship. Developed economies have also experienced varying levels of inflation. For example, the US and UK faced high inflation rates in the 1970s due to oil shocks and monetary policies, leading to significant economic challenges and policy changes. Modern challenges and future outlooks on inflation involve multiple factors. Globalization significantly impacts inflation, as global supply chains and trade policies influence the prices of imported goods. Disruptions in global trade can lead to price increases. Technological advancements can both mitigate and contribute to inflation. Automation and improved productivity can lower costs, while new technology products might command higher prices. Environmental factors, including climate change and environmental policies, can affect production costs and prices, particularly in sectors like agriculture and energy. The rise of digital currencies presents new challenges and opportunities for managing inflation. Central banks are exploring digital currencies as potential tools for monetary policy. Inflation is a complex economic phenomenon influenced by various factors including supply and demand dynamics, production costs, monetary policies, and global events. While it can erode purchasing power and create economic uncertainty, there are strategies to manage and mitigate its impact. Understanding the underlying causes and implementing effective measures can help individuals, businesses, and governments navigate the challenges posed by inflation.